There's a question really on whether it's about capital reservation or taking advantage of opportunity in the market right now. Well, our next guest may just be dipping a toe into the water. Bogdan from Blackmore Capital joins us now via Skype. Marcus, pleasure to have you on the show as always. First up, give us an idea of where you're standing, because I asked this question to a lot of our guests, whether you're preserving capital or whether you're taking advantage of opportunity. And there seems to be a bit of a swing now where more and more people are starting to take advantage of opportunity. Where are you right now?
Good morning, Ingrid. We're still in the camp of being on the defensive, the structurally sound companies, because I think the pathway out, we believe, will be elongated. It will take time, and there'll be pauses and disruptions along that way. Notwithstanding that, we do see some signs of recovery. In areas such as consumer staples, we're seeing more normal practices in supermarkets now, but also in the less obvious in consumer discretionary, where we're speaking to a number of retailers that are looking to open up their shops again in the September quarter. And so they're now planning with marketing and branding and campaigns. And so we're starting to see the first signs of a tentative recovery there. And then areas in like healthcare, we've got elective surgery coming back for Category 2 and some parts of Category 3, a push by the health authorities to return to going back to your general practice for diagnostics and pathology. And then looking at China, which was the first into this crisis and probably the first out of this crisis, we are seeing signs of a recovery in some commodities, particularly iron ore. And that bodes very well for BHP and Rio. So our tilts are definitely still defensive, consumer staples, defensive industrials, telecommunications and some technology. But we are now starting to add and to think about looking at some high quality cyclical companies with strong balance sheets.
Well, I want to dig into your thoughts there, because when you talk about discretionary, is it a sense of, build it and they will come when it comes to sort of reopening some of these retail stores? Because I guess the question is, it's one thing to reopen and relax lockdowns, but it's another thing to get consumers in the door and spending money.
Yeah, I think that's a really good point. And I think what we have to grapple with going forward is this social distancing. And so the capacity of stores and businesses to allow the public in will be limited. And so I don't think we will get to the sorts of the returns of the profitability that we saw at the peak of sort of September 2019, returning until FY 2022. So I think you'll see a pickup, some level of normalisation, but also held back by the fact that we will still continue to have social distancing for a period of time.
In terms of the non-discretionary, the more the staples like Coles, who have come out today with third quarter sales, obviously smashing expectations just because of the panic buying. But going forward, do you see a return to normalcy as a positive? Because obviously, we're coming off the highs that they may have seen through this crisis, but at the same time, you'd imagine there's a bit of a lag effect to people who have perhaps stocked up, don't need to shop for a little bit of time. I mean, how are you viewing Coles in this sort of situation?
Sure. I mean, we're still positive on both Woolworths and Coles. I think structurally and how the industry is positioned, I think they still remain very attractive businesses. And I think you're right around sort of dry goods. There has been some stocking up there. And, going to your point in earlier interviews, these sort of structural longer term shifts, I think there probably will be a more conservative consumer. It will take us time to go back to restaurants. And so for the foreseeable future, I think the demand drivers for supermarkets and particularly Coles still looks attractive.
Talk us through some of the things you're watching in industrials and logistics, in particular, some of the cyclical names or what you're looking for in this sort of area.
Sure. So we're sort of focused on the defensive cyclicals, such as Cleanaway Waste Management, which has a very stable business in terms of household waste, And where they've seen a downturn has obviously been in the SME market, where they service around 180,000 customers. So we'll be looking carefully to see a return of normal volumes there. And I think that'll be a very good litmus test there. Another a strong industrial that we look at is Brambles and the movement of goods on their pallets, both here in Australia and also in the Northern Hemisphere. And again, I think they'll be a good litmus test for big markets such as the United States. And then even the more cyclical ones, which are far more trade-driven, around Cube, which are currently suspended pending an equity raising.
Well, interesting you mentioned equity raisings. It's certainly the topic du jour at the moment, with lots of businesses announcing capital raisings to shore up balance sheets. What's your take on this and whether or not to participate in these capital raisings? You know, obviously it depends business to business, but you've got, you know, share placements by companies like Cochlear having to actually expand due to oversubscription by investors and popularity. So what's your take on this sort of scenario?
Yeah, I think the equity raisings are inevitable, and we saw that in the global financial crisis. And quite often we saw companies having one or two or even three equity raises through the crisis. So we're looking with the lens of quality and sustainability and good market position. So Cochlear, Ramsay, Cube, those are the types of companies that would be more attracted to, rather than the ones such as the banks, where we still think that there's a long way out in terms of return to normalcy there.
Yeah, and dividends are an interesting topic as well, given what we just saw from the NAB raising capital to pay a dividend, albeit a small one. What do you make of companies sort of suspending dividends going forward, and when do you think we'll get some sort of normalcy back when it comes to returning this sort of cash to shareholders?
Well, I think it will be some time, and I think you'll see actually dividends fall at a greater rate than earnings, and you saw that with NAB in the last couple of days. I think longer term, I think it is a good thing that the payout ratios are more conservative going forward. But I still think you can still build a portfolio where you've got a group of companies in those defensive sectors that will be able to either hold their dividends or marginally reduce them. And so that income stream for investors will still be there. But it is very, very selective at this point in time.
In terms of markets, obviously we've got earnings happening in the US, and that's, I guess we're seeing, it all depends on consumer expectations, but certainly somewhat being looked past at the moment. Do you think in Australia a similar scenario in terms of what we're watching with quarterlies, but also with the banks that are out reporting? We've obviously had NAB, we've got Westpac and ANZ, and CBA's quarterly, because it's out of cycle, to be released. How do you think investors are going to respond to these ones?
Well, I think they're indicating the stress that we're seeing in the economy, and I think this provisioning will go on for several quarters, and it'll take a while for us to reach more normal profits. And again, I think we won't see a normal profit season until FY 2022. But the markets look forward; they look through a lot of that, and that's why you're starting to see some elevation in prices at this point in time.
All right, Marcus, appreciate your time on the program. Thank you so much for joining us.